Welcome to this very special edition of SKC Office Hours. I'm Sarah Crum, Managing Partner of SKC & Co. CPAs. Today, we are bringing you a pre-recorded office hours focusing on what we can expect in the tax landscape under our new president. Joining me today is SKC's newest hire, Nicole DeRosa. Nicole joined our team just a few weeks ago as our Director of Tax. Welcome, Nicole.
Hello, happy to be here.
I am excited that this is your first time joining us on Office Hours, and this topic is right up your alley because you are a self-proclaimed tax guru.
Yeah, super excited to be here. I'm even more excited to be at SKC and also equally as excited to be joining you on Office Hours today on such a relevant topic.
So without further ado, let's jump in. Here's what we know, and let's start with the facts. We had an election a few weeks ago. We have a new president coming into office in January. We have a Republican Congress, and we have provisions from the Tax Cuts and Jobs Act, originally passed in 2017 by President Trump at the time, which has provisions that are set to expire December 31st, 2025. So what we're talking about is still in place through the filing year for 2025, and any changes that will happen are expected to happen January 1st, 2026. So I want to be clear that neither Nicole nor myself have a crystal ball. So what we're going to share with you is our research into the points that President Trump has openly discussed he's in favor of during the campaign and since winning the election. So Nicole, let's start with the Tax Cuts and Jobs Act, which we are probably going to refer to as TCJA going through the rest of this presentation, just because it's easier and shorter. And what provisions exist today that many of us know that are set to expire if action isn't taken? Can you tell us a little bit about the TCJA and those provisions?
Sure thing. Now, a crystal ball sure would be nice. So with more than 4 trillion, and yes, I said trillion, of tax increases scheduled to take effect at the end of 2025, next year could be the most important year for tax legislation since 2017. And since the Tax Cuts and Jobs Act was rolled out. So some of the more notable provisions set to expire in 2025 on the individual side, we're going to kind of break it down and just go through hitting each one short and sweet kind of. So for the individuals, we have the rates and we have the brackets. Now, unless Congress takes action to extend these rates or make any other changes, the tax rates for individuals will revert back to the pre-2018 structure, with the top rate going back up to 39.6, which is currently at 37%. So bracket entry points will also revert back to the pre-2018 levels as well as adjusted for inflation. So expect to see some changes there again, unless legislation is passed in the interim. In addition, we have the standard deduction. So similar to the tax rates, the standard deduction will also revert back to pre-TCJA levels, which were scheduled for 2018 to equal $6,500 for a taxpayer who's filing single or married filing separate, $9,550 for a taxpayer who's filing as head of household, and $13,000 for taxpayers filing as married filing joint and also who are surviving spouses. These amounts will be adjusted for inflation, of course, but to compare, the standard deduction for 2024 is equal to $14,600 for a taxpayer who is filing as single or married filing separate, $21,900 for a taxpayer filing as head of household, and $29,200 for taxpayers filing as married filing joint or surviving spouse. So we do see some significant differences here as well. Moving along to the personal exemption, which also kind of layers into that standard deduction. So the personal exemption was suspended for tax years 2018 through 2025, and as such would be reinstated for individual exemptions, which include exemptions for not only the taxpayer's spouse, and any dependents. This amount is indexed for inflation as well, and despite there's no tax deduction for 2024, the actual amount is $5,050. So again, unless legislation is passed, these will actually come back, and that'll factor into the standard deduction as well and kind of close the gap a little bit, if you will.
Now, what's so interesting, Nicole, is obviously when this was passed back in 2017, inflation was in a very different place than it is right now.
Exactly.
And so a lot of these provisions have been, as you've said, aligned with inflation. And now we're talking about the expiration of these provisions reverting back to, this is not the right term, but I'm going to say it this way, pre-inflation levels to what we know. And, you know, again, no crystal ball, but I can't imagine that the expiration of these is just going to be allowed to happen without there being some further movement to either extend or to make them permanent or change something even further, involving these things?
Oh, they're going to absolutely have to do something. I mean, even if you just look at the standard deduction history over the last couple of years, I mean, historically, the inflationary adjustments were a couple $100 here, a couple $100 there, but now they're jumping a couple $1,000s here and there. So yeah, I mean, I would say we'd be remiss if we didn't say that there would be some sort of an inflationary true up, if you will.
Mhm.
But I mean, regardless, it's going to be an adjustment, significant adjustment for the inflation factor.
Right.
All right, let's talk about the child tax credit, because that is, I feel like, a very hot topic with regard to not only potential expiring provisions, but also just in general. So the child tax credit, like I said, well, we're going to revisit this when we discuss new policies potentially in the next couple, minutes. But if nothing is passed, the credit will revert again back to lower amount, $1,000 per qualifying child, with a portion being potentially refundable depending on earned income and modified adjusted gross income levels. Currently, that credit is at $2,000 per qualifying child, with a portion being potentially refundable again, depending on earned income levels and modified AGI levels. The income phase out is much higher for married filing joint taxpayers. The phase out threshold as a reference is currently at $400,000 versus the pre-Tax Cuts and Jobs Act amount of $110,000. So again, we're seeing a lot of kind of potential for, reverting back, and it's not just like a small adjustment. So that'll be interesting as well. Other dependent care or other dependent tax credit, mind you, currently is a $500 non-refundable credit. It's available for qualifying dependents and other than qualifying children under the age of 17 who are eligible for the child tax credit, assuming that the taxpayer does not make too much money. This credit will poof, basically just be gone. There is no provision under pre-Tax Cuts and Jobs Act for an other dependent tax credit. So moving along now to the itemized deductions. These are always fun, I feel like. The SALT deduction, another very, very hot tax topic. Pretty self-explanatory. We're very familiar with it, being in the tri-state area. We know there is a big fat $10,000 cap on state and local tax deductions. And assuming no legislation is passed, which is not likely for this red hot ticket item, the SALT cap will be eliminated, which I know a lot of people would be happy about, but realistically, I don't know if that's going to actually happen.
It's so interesting though, because again, this was passed in 2017. And again, being in New York, New Jersey area, we've also got our office in California, Maryland, these states, on the coasts that have significant state tax dollar amounts paid by individuals and or real estate taxes, right? They created a workaround. And that's the pass-through entity tax for at least business owners, that you are allowed to deduct you're allowed to deduct through the business the portion of your state tax attributable to business income. And this was essentially the workaround that came out in response to this SALT cap. So if they have movement on the SALT deduction in the new administration, it will be interesting to see what the states choose to do with the pass-through entity tax, because, some states are really just getting their systems up and going and refined in the last couple of years.
Yeah, so I believe there's 36 states and one locality actually that has a pass-through entity tax regime to date. Now, honestly, even if the SALT cap is lifted, realistically, I don't see the states reverting back and getting rid of their pass-through entity tax regime, just because so many people partake in them. B, when we look at AMT, state taxes is one of the biggest add backs. So to kind of skirt around that AMT add back, I don't see people even reverting back to not electing into a pass-through entity tax regime. I don't see those going away. I do see them sticking around for quite some time.
It's one of the reasons why I'm not actually convinced that there's going to be any movement on the SALT deduction cap, because I feel that it sort of was solved for itself by the states. And why put the energy and the effort behind it, I think, at this point, from a federal perspective, at least.
Yeah. And for non-business owners, I think that's the only reason why they would potentially lift it a little bit.
Yeah.
Because if you're not a business owner, you're not partaking in the pass-through entity regimes. But yeah, I don't think it's as big as an item as it used to be before all the pass-through entity tax stuff. But it's still obviously very hot and forefront for legislation.
Yep. What else do we have?
We have the P's limitation, probably not really one of the big ones, but under the Tax Cuts and Jobs Act, the overall limitation on itemized deductions was eliminated for tax years 2018 through 2025. This overall limitation is set to be reinstated and indexed for inflation. Historically, it was a 3% limitation on itemized deductions. So it didn't really impact things too much, but it was still present. And then 2% miscellaneous itemized deductions. So similar to that P's limitation, those 2% miscellaneous itemized deductions were eliminated, which they're set to be reinstated. And I know a lot of people with hefty investment expenses and all those unreimbursed business expenses that would be pretty happy about this one if those 2% were reinstated.
Yeah, they're not ones that typically make the headlines when we talk about some of the taglines that the news might portray on the TCJA and future, tax policy, but they are, at least our clients that we work with, we tend to see these ones being pretty impactful for individual returns.
Yeah, especially, I mean, we'll talk about states probably later too, but there's still some states that don't follow the Fed. So on the state side, they still are having their 2% miscellaneous itemized deductions, whereas the Fed, it's a no-go. So it'll be nice to have things maybe aligned again a little bit more.
Right.
If they are reinstated.
And last one for the individual side of things, we have the AMT. What do you have to share about that?
So Tax Cuts and Jobs Act, if you recall, re-indexed the exemption and the phase-out thresholds for AMT, as well as adjusted everything for inflation. So AMT actually did apply to the originally intended target audience, not necessarily middle-class taxpayers and just high net worth individuals anymore. So without legislation, the AMT exemption amounts and the phase-out thresholds would return back to pre-TCJA levels, and we'd see a significant uptick in taxpayers that are subject to AMT again. As a reference, just for married filing joint taxpayers, the AMT exemption for 2024 is $133,300, and the phase-out threshold is $1,218,700. Pre-Tax Cuts and Jobs Act levels, 2018 exemption is $86,200, and the phase-out is $164,100. So significant gaps there.
Yeah. The good thing about the fact that we're pre-recording this, although all of our office hours are recorded, is you can view it as many times as you want and kind of get some of the more detailed, nuanced things that we're throwing out there. We kind of have high-level slides presented, but this will allow for the audience to share it with colleagues and, of course, revisit it themselves. But let's move on to some estate tax issues that are all part of TCJA as well.
So we only have one, but it is a big one. As we currently stand, the 2024 exempted amount is $13.61 million per individual, indexed annually for inflation, and applies to estates of decedents, dying, gifts made, and generation skipping transfers that are made. With no legislation, the exemption amount will revert back to pre-TCJA, which was a whopping $5 million per individual. So index annually for inflation is estimated to be about $7 million in 2026. So another potential huge change that many are keeping a close eye on for obvious reasons.
So, by the way, love the graphic on this slide. I think it's hysterical. It's important to mention, and this applies to all the provisions that we're talking about, but I think it's highlighted well on this slide, is the component about inflation, because you'll hear, oh, we're reverting back to pre-TCJA numbers and amounts. And that's not entirely true. We are applying inflation for that time period that, we had TCJA. So that's why Nicole says in this case, what was pre-TCJA of 5 million, once we index it for inflation to get to 2026, it really brings us to 7 million. And that applies to all of what we're talking about with these expiring provisions.
Yes. It's clearly just magnified here with this one because it is such a large jump.
Yeah, I mean, but still, if you think about it and compare it to where we are currently at the 13.6, I mean, that's a giant leap with making estate tax plans and funding trusts and gifting. I mean, it's a big impact for people to revert back, even if that number adjusted for inflation is 7 million.
Yeah, this is a big one. This is a big one. I think this is probably what a lot of people are really concerned about, especially, those high net worth taxpayers, just because their estates are massive, and
yeah,
potential for tax is also, as a result, massive if it does revert back. So
Yep.
we'll see. Crystal ball, I wish it existed. That'd be nice.
I don't know if I want to see what's going to happen. I think I'll just take it one day at a time.
You're a roll the dice type of girl. I love it.
So this TCJA was a huge tax policy initiative when it went through in 2017, and there is a significant component, as with some of the individual and estate pieces as well, on the business side. So Nicole, walk us through what's expiring and what's set to happen if nothing is done.
So a couple of big hit items here. First and foremost, the qualified business income deduction. This 20% deduction taken against qualified business income from flow-through entities or sole proprietorships would disappear in its entirety if no legislation is passed. Now that, in my mind, would be completely messy, especially because all of the carryover stuff that potentially has accumulated over the years if there was losses. But it would just poof, be gone if no legislation is passed. Excess business loss, another similar item, but not necessarily going away just right away if no legislation is passed. But this is a limitation on non-corporate taxpayers, is the amount by which the total deductions attributable to all the taxpayers' trades or businesses exceeds the sum of the taxpayer's gross income or gain that's attributable to those trades or businesses. So for married filing joint taxpayers in 2024, it's a $610,000 limit. It's applied after the passive activity loss rules. Previously extended for 2 years under the Inflation Reduction Act, this provision is set to now expire in 2029 if no future legislation is passed. So this can was kind of kicked down the road a little bit for the time being under IRA. Bonus depreciation, that is another hot ticket item. I feel like this is always front and center, rightfully so, because it is a big one. We got pretty used to the 100% bonus for a while until it finally started to phase down to where now it currently sits at 60% for 2024, and it's slated to drop again for 2025 down to 40% and then down to 20% in 2026 until it expires if no legislation is passed, which I honestly don't believe that this is likely. Since we've already seen movement earlier this year about reinstatement of bonus depreciation, it'll be back. It's not, I don't think, going anywhere. Not that I am certain of. Obviously, we don't know when and how much, but this is definitely one of the hot ticket items, especially for business owners.
So the one thing I want to focus on before we move to the next bullet point is the QBI piece, right? And for audience members who may not know the nuances that we know as, tax advisors, is the corporate tax rate. So if you're not a pass-through entity, if you're not an S corp or a partnership, or even a Schedule C, the corporate rate was changed and reduced in the passing of the TCJA, and that reduction was made permanent. So the expiring component is this QBI deduction, which was intended to balance out the reduction of the corporate tax rate, again, made permanent. QBI, not made permanent. So there will be a misalignment in the event that the QBI expires or isn't made permanent or isn't extended or what have you, with what the taxes would be for a pass-through entity versus the continued reduced corporate tax rate. And it's just a little nuance of talking about policy and how it may affect you if you're in the audience, because most of our clients at SKC are pass-through entities. I could probably count on one, maybe 1.5 hands how many clients we have that are actual C corporations. So I don't know that there's going to be a misalignment when all is said and done, because I don't think that would be very appreciated tax policy from the majority of business owners, which are the small business owners, the backbone of our economy, having that misalignment between pass-through entities versus not pass-through entities of the tax rate. So I just kind of wanted to throw that in there. Again, I can't tell you what's going to happen, but I wouldn't imagine there's going to be a perpetual disconnect between pass-through entity tax and corporate tax.
Yeah, because then entity selection would become really important. But also you foreshadowed something that we're going to bring up. I'll dangle that cherry for a little bit. We'll get to that in a little bit.
But another very hot topic for R&D research and development costs has been actually in the news for a while, because this actually started to change before we get to the end of 2025. So let's talk about the amortization of the expenses related to this.
Yeah, so we did see movement earlier this year. Prior to 2022, businesses were able to deduct research and development expenditures in the year that they were paid or incurred. However, now you have to capitalize and amortize the expenses. Depending if you're domestic expenses, you have to spread that across 5 years, or if you're foreign expenditures, you have to spread it across 15 years. So, a lot of people were hoping that this was kind of going to be a retroactive change with the tax bill that was, it looked promising when it first was introduced earlier this year, and then just kind of like came to a screeching halt. But I mean, obviously it's one of the items that have been on the table, and we've been seeing some rumors about this in recent months, I would say. So I would say this is probably one of the more favorable items, just because it's already a bipartisan supported item.
It is. It's bipartisan, and it was heavily lobbied for.
Yes.
I mean, the architects, there were a lot of really strong lobbying organizations and
Yeah.
industries that came out in support of this. It has bipartisan support. It's one of those things where we're all kind of like, come on, everybody, let's just make this happen. And hopefully that happens at some point in 2025 when the new administration comes in.
I have my fingers crossed. I think this is one of the more favorable items that would be, along with bonus, is definitely one of the ones I think is more of a
Some low,
splash.
some low hanging fruit that can just,
Yeah.
make business owners happy.
Yes. Happy life, happy, oh, I was a happy wife, happy life, but happy business owners.
We'll have to
Last,
figure out a rhyme for that one.
yeah, we'll figure it out. So last but not least, limitation on the net business interest expense item. TCJA created the code section 163J, which generally allowed a deduction for net business expenses, net business interest expenses in excess of 30% of adjusted taxable income. However, the calculation to arrive at ATI has changed a bit since it was first introduced. Currently, the add back for depreciation, amortization, and depletion is not factored into ATI. However, there have been more rumors to bring this back. A higher or a bigger add back would arrive at a bigger base, which would allow for more of a deduction. But until this happens, we are stuck with a more unfavorable ATI calculation. But this is another item that has been a big ticket item, and at least rumored, because we've seen movement here as well.
So as I said, President Trump was the president at the time that TCJA was signed into law. Nicole, any sense of what his intent is with some of these provisions?
I mean, I everything I basically previously mentioned with regard to TCJA, President Trump would like to make permanent. But I typically put air quotes around the word permanent because in tax land, permanent doesn't actually mean permanent forever per se. It just means permanent until future legislation tweaks it down the road, or at a later unknown time. But there is, however, a difference between the technology permanent and extended. Extended just kind of means that the can is being kicked down the road for a little bit, just, like the business losses. That was a 2-year can kick essentially, but it'll be interesting to see what's made permanent. I do think that the intention of President Trump would be to make the TCJA provisions permanent.
And, typically we'll see possibly an extension of some if there was, a mismatch of, R's versus D's in the House or the presidential seat. But we pretty much have R's across the board with everything. So we may not need to do extenders to make everyone happy. We may be able to do something, a little bit more permanent, as Nicole says, with the new administration, but we'll see.
Yeah, and also, I mean, depending on how it's passed, I mean, if we're looking at budget reconciliation, you have to kind of make the numbers work. So however the numbers work, whether it's a permanent or just an extender, you fit it into the box and it passes through like a pretty little present. So, I mean, that is going to depend heavily as well, how they're going to, what vehicle they're going to use to pass any tax legislation.
Right, exactly. So that's what we know today. We know what's set to expire. We know what to expect in January 1st, 2026, if there's nothing done about it. But let's move to some of the new ideas that came out during the campaign. Nicole, can you share some of what President Trump's new political potential policies are with regards to tax? And I know, again, my disclaimers up and down on this episode. These were what was put out into, for public consumption during the campaign and since the election, as far as policies that President Trump favors. have no idea what's actually going to be put forth and what really will end up being passed ultimately, if anything. But again, with so many things expiring with TCJA and there being quite a strong feeling from President Trump during the campaign of other changes, there's probably going to be very robust tax legislation in the coming years to watch out for. So, Nicole, what might we possibly have in store with some new policy?
So some of the policies I already foreshadowed a little bit, but we're going to dive into some of the more noteworthy new policies now. And just like you mentioned, Sarah, a lot of these policies, yeah, they came out, they are pretty public about it, but they are still lacking a tremendous amount of detail. So we are very limited on each of these proposals. So let's start off with the individual side and creating a universal $5,000 child tax credit. This actually, we know for a fact that JD Vance has publicly floated the idea of this $5,000 child tax credit that would apply to all American families. But again, keep in mind, usually there's income limitations and there's other stipulations and details that drive this amount. So, the TCJA provisions, if they're made permanent, the credit would remain at $2,000, but obviously this is a different number than the Tax Cuts and Jobs Act provision. Reinstating the unlimited itemized deduction for the SALT cap, or even maybe discontinuing the SALT cap. For a while now, there has been strong bipartisan support on raising the SALT cap or eliminating it completely. This move would likely face resistance from fiscal conservatives and budget hawks who are, as raising the cap or eliminating it completely would significantly reduce the flow of tax revenue. So, it does depend. And again, depending on if we need to pass it through budget reconciliation, making those numbers work, this is, I think, a big area where they'll kind of use as, a play area, whether it's, raising the cap to 60,000 or removing the cap. Those are two very extreme potential differences. So I do think that we will see movement here. It's just a matter of where that movement will actually land.
Mm-hmm.
Exempting certain income from taxation. So this is actually an interesting one. Several income types, specifically Social Security benefits. Right now, up to 85% of Social Security benefits could be taxable, but Trump has indicated that he would support legislation exempting Social Security benefits from tax in an effort to help retirees financially. Tip income, pretty public as well. We've previously seen multiple bills introduced that would create an above the line deductions for tip income, thus exempting tips from federal income tax. And it's important to note that each of the bills introduced did treat the taxability of tips differently for purposes of the payroll tax. So we had the income tax and we also had the payroll tax. They are not one and the same. So very important to kind of just differentiate there. Similarly, overtime pay, key details missing, but we do know that the employee side would not be subject to payroll taxes, the 6.2% for Social Security and the 1.45% for Medicare. And then also, last but not least, workers of certain occupations, firefighters, police officers, military personnel, and veterans, that income would also be potentially exempt from taxation. Now, again, federal taxation, not to be confused with state taxation, because the states love to do their own thing.
Yeah, and I think when he came out publicly, it was probably under the umbrella of first responders, earnings that first responders get. I think this is a good point for me to interject and say, again, we are reporting on what has been put out for public consumption. We could have a whole separate conversation over your favorite beverage about how this impacts the national debt and other policies, foreign policy, and things of that nature. Not something for today's presentation, but certainly there are other outside factors to some of these policies that, as you see the new administration take office, this is going to be what is discussed, I think, in a more real-time manner than, these are just some of the hot buttons that have, again, been put out for public consumption.
Yeah. Oh, absolutely. And there's a lot to discuss on that front, just because, all of these items that we're talking about today impacts, it's either a revenue raiser or a tax cut, and they're pretty substantial both ways. So it's, again, really interesting to see, what the projection is of, 5-10 years down the road and what potentially it could add or take away from deficit.
Right, exactly. So we've got some more coming at us. What else on the individual
Yeah, we
side?
have a creation of a deduction for auto loan interest. Historically, personal interest has not been deductible as an itemized deduction. However, this newly created itemized deduction would be similar to that of mortgage interest expense, except it would be allegedly deductible in full. You wouldn't have a limitation on it, unlike mortgage interest limitations. And then creating a tax credit for family members who are serving as caregivers. Although, again, details of this proposed tax credit are not specified. Both the House and Senate lawmakers have shown bipartisan support for a tax credit up to $5,000 for eligible caregivers. Trump has not specified support for a specific design, so it's still a bit unclear what will actually shake out here.
How about businesses? What has he floated out there about business tax policy?
So here's the cherry that we dangled earlier.
Uh-huh.
Reducing the corporate income tax rate from 21% down to 20, and then also perhaps down to 15%, which would be massive. So initially reduced by the Tax Cuts and Jobs Act from 35% down to 21%. Trump has openly supported dropping the current 21% corporate income tax rate down to 20%. And in addition, he has said that he would actually drop that rate further down to 15% for corporations that actually make their products here in the United States. So incentive to kind of keep everything here in America. He's potentially going to maybe reduce it even further down to 15.
And this is really the area, as we go through a couple of these bullet points, where you're going to see that influence of foreign policy mentality in some of these tax policies that he's floated out there, because some of them are certainly incentives and some of them are clearly punitive.
Yes. And this is, I mean, there's some pretty massive ones here, especially
Yeah.
in the slide, as you can see, before I even go into them. Moving down though, eliminating the clean energy, many of the clean energy tax credits enacted by the Inflation Reduction Act, without, diving down too much of a rabbit hole here, there has been significant investment across the country driven by the Inflation Reduction Act that could help protect some of these clean energy credits. However, the price tag on the Inflation Reduction Act seems to have been understated, which is why these credits are now being looked at so closely underneath the microscope. Sections 30D and 45X are the two major items that appear to be on the chopping block. Code Section 30D basically bars companies, electric vehicles from qualifying for that $7,500 consumer tax credit if the EV is the battery components were sourced from a foreign entity of concern. There's a whole list of the entities which constitute foreign entities of concern. Code Section 45X surrounds the manufacturing tax credits that are available to companies that establish certain clean energy factories here in the US. But outside of these, again, we don't have too much detail as which specific clean energy credits would be eliminated. So a little vague. That's why I said we're not going to dive down a rabbit hole here.
And again, the influence of foreign policy, right? So although many of our audience members may not be impacted by the clean energy tax credits, if you dive a little bit into the detail, you can see there's, again, a component of if things are sourced from a foreign entity of concern and if things happen in the United States, there's very much a foreign element to the business tax policies that he's floated out there.
Yeah, and the devil certainly is in the detail on all of these for sure.
Which we have none of.
Yeah, basically. So now we're going to talk a little bit about tariffs because that's also, a big ticket item. It's pretty much at the forefront, I feel like, of news headlines everywhere. But tariff related items, to be increased, imposed, and implemented in an effort to reduce trade imbalance, as well as boost U.S. manufacturing. Perhaps the most controversial of Trump's tax proposals, as critics suggest that tariffs would only result in lower income for workers and business owners. This obviously all remains to be seen, and the details have not yet been ironed out. But the various tariff-related policies that we have heard about include raising the current tariffs on Chinese goods to 60%. During Trump's first term, he actually quadrupled the tariff of imports on Chinese goods from 3% all the way up to 12% on average. And it's looking to perhaps quintuple the tariff again. Imposing a universal tariff on all U.S. trade imports of 20%. And then also implementing a foreign retaliation of 10% on all U.S. exports and an additional in-kind tariff on U.S. exports to China specifically.
Okay, so there's clearly a message there.
Little one, just
Uh,
little.
So, I mean, tariff again is Nicole, you said it, it's this headline grabber that we've seen probably since, I don't know, maybe 6 months ago as part of the campaign and certainly thereafter the election. For the audience, can you succinctly describe the difference between what we know in the US as an income tax and what is meant in these situations by the term tariff? Because they are not the same thing.
No, not at all. So tariff in theory is an excise tax that is applied on imported goods. Tariffs create kind of like a wedge between the price a consumer pays and then the price that the producer receives. And then the wedge kind of reduces the amount of revenue businesses have to compensate their workers and shareholders, which then is a reduction in income. Conversely, tax applies to, broadly to a range of economic activities, income sources, purchases, property, and then transactions. So they are two very different items.
Right. One is almost a cost of, let's just say, the widget, right? And the other one is a tax on the income earned from producing the widget, is kind of an oversimplification of it.
Yep. I love it though. Make it simple. Keep it simple.
I try, right? I do want to mention something that we did touch on briefly through this presentation, and that's the relationship between the states and federal tax policy. So, Nicole, you kind of alluded to this, that states have a right to decouple from federal provisions. So whatever does happen to get passed into federal law may not apply to your individual state, and it's important to note that as you listen to what may be happening legislatively, and understanding from a planning and a projection standpoint that if it's happening on the federal side, that does not guarantee that it's also going to happen on your individual state side.
Yeah, and I mean, I'll add every state is different in their application and treatment, so never assume. But also, there are some states that automatically now follow the Fed, but that's kind of the minority. I feel like most states decouple and they like to be different, for whatever reason. But it's definitely every state is not the same in, if they follow the federal application or not.
Right. Exactly. And another important point to raise is that tax legislation actually originates in Congress, so not the White House. And although these tax policies that we're discussing and that we've potentially talked about have been floated through the campaign and by President Trump and may be endorsed by him, that does not necessarily mean that they're going to convert to new tax law, because it does need to originate in Congress before anything can happen. And I just think that's an important nuance to understand how sort of our branches of government work when it comes specifically to tax legislation and tax policy. Nicole, any final thoughts to share with our audience today?
I mean, aside wishing for we had a crystal ball, predict the future. No, all joking aside, I feel like next year will definitely be a pivotal year for tax legislation, at least tax talk. There will be a lot of, I think, noise, a lot of clamor, a lot of rumors, and hopefully tax legislation. So just making sure to kind of do your best to stay up to date on the potential for future changes and educating yourself on the impacts will become very, very important. Of course, here at SKC, we're always here to help you navigate any questions that you may have along the way, but definitely just staying up to date and educating yourself is going to be the most important thing over the next year or so.
Absolutely. And I know it's unusual for us, if you're a frequent office hour listener, to not have a live session with Q&A, but we do want to offer Nicole's email address here if you have any questions or any topics that you want to dive deeper into based on what you've heard today, so that you can speak directly with her. Of course, you can always reach out to me, or you could reach out to Brittany and she can put you in touch with either me or Nicole. But we do want to offer that for you, since this is not a live presentation this go around. But we do want to thank you for joining us today, Nicole. It has been a gift to have you on your first office hours with SKC.
My pleasure. Thank you so much for having me.
Absolutely. And to our audience, please share this edition with your friends and colleagues. Again, revisit it as it's recorded, and you're welcome to do that at any time. It will eventually land on our website as one of the resources. Again, Nicole, we appreciate you being here. We look forward to you joining us on future office hours. I am sure with the robust tax policies that we expect to see coming through in 2025, that we will have you on another office hours that dives deeper into the actuality of some of these ideas and whatever new tax law might be there. This is our last office hours for 2024, so please have a happy and healthy holiday season. We have a great lineup already scheduled for 2025, so we look forward to providing you more valuable content then. But until then, have a very safe and happy holiday. Thank you all so much.